Dying to know, we heard in the statement, obviously, it said the Fed will reinvest money that's coming out of the MBS market into government securities. In other words, they're keeping their eye on the ball. You're seeing the market rally. Is that the best of all scenarios, that the money will stay invested, that the Fed cares?
That's exactly what they're saying. And another issue here is what the Fed was concerned about, and that was what I was talking about earlier, is that if they let their balance sheet go down, that in this environment of disinflation, which we were talking about earlier, even though it's a couple tenths of a %, that the real rate of interest is actually rising. And so what they're worried about is trying to offset that by, if they let their balance sheet naturally drain off, that would be an implicit tightening of monetary condition. And they want to offset that by keeping monetary policy steady, they believe, by keeping the target on their, now they're targeting their balance sheet, keeping that at a steady pace.
Does this
that $2.2 trillion ain't going away anytime soon.
And does it open the door that, since it's not going away and staying put, they could actually increase it down the road?
Absolutely. That is not out of the range of possibilities. And although Congress, the Congressional Oversight Committee, did get into the financial reform some ability to review the Fed's purchases over time, they do it after the fact, and the Fed could increase their balance sheet. And they did, as you noted, they've already had it higher than it is at the moment. So technically, given the disinflation we have, monetary policy is tighter than it was at the peak of the Fed's balance sheet. So they're looking at that as a benchmark in their own mind. So they could go back up to $2.5 trillion. My guess is they'll try to keep it pegged at $2.2 trillion, but if they have to, they'll do what they need to. Diane, they don't want to look like they didn't do anything when they should have.
Diane, what do you also make of the Fed saying the recovery to be, quote, more modest than expected in the near term? Last time we heard from Ben Bernanke, he said economic outlook remains unusually uncertain. Some wondered whether or not we'd hear that term again in the Fed statement. They're saying more modest. What do you make of kind of the differences, or are there any differences there?
It just tells you that they've downgraded their forecast. They were uncertain, and we knew they would. If they weren't, they would not be awake at the wheel. I mean, come on, the GDP data, as you noted, even today, half a dozen statistics suggesting that the GDP data is worse than it was. The recovery is losing momentum. Clearly, employment is losing momentum. And at the end of the day, the unemployment rate is what really matters, although it is, in economic terms, a very volatile term. Politically, that is what matters, and that is what the Fed is focused on in an environment of disinflation.
I mean, Diane, you agree? I mean, it's all really on the back of the United States here in terms of the growth that's going to fuel the rest of the world at this point, despite all the talk about the emerging markets and the significance and growing significance of those markets?
Actually, I disagree slightly in that China's played such a major role in bringing back exports worldwide. We saw news out of Germany that Germany's exports have done well. That's on the heels of developing economies doing well. China has become very integral as an export market for us in the United States and for other economies. And almost everywhere you go, I've met with economists all over the world recently in a meeting, international meeting in Mexico, and it is amazing how many people cite China as the backbone of their export machine at this stage of the game. So although the U.S. is critical in the global economy, the world has to really adjust to the fact that the U.S. is no longer the consumer of last resort and can't play the Atlas it once did holding up the rest of the world. Clearly it's not doing that on the consumer side. So as important as the U.S. is, the momentum in China, if it shifts down much more dramatically than it already has, could have big ripple effects through the rest of the world.
Does the U.S. and everybody also have to get used to what everybody keeps talking about, is this new normal brought out by PIMCO? We talked about it earlier in our broadcast, but do we need to kind of adjust to a slower growth rate here in the United States, that is really the new norm?
Absolutely. I mean, that's one thing that, certainly we've been forecasting for a long time. We have very subpar recovery. Those people kept saying that the depth of recovery or the strength of recovery would be determined by the depth of recession. We just didn't agree with that. I think we're seeing that. Unfortunately, it's really hard to live the reality of what a subpar recovery is. It's a period of extended high unemployment. And this is very reminiscent of what Europe went through when they lost a lot of workers who just gave up entirely. We're now starting to see that in the U.S., and that's very dangerous.
So we need to accept it, or do we also need to ask the government for more stimulus to kind of help us out here? Where do you weigh in on that argument?
I do support the stimulus, the transfer to the states to get us in terms of bridging some of this, saving some of the teacher jobs, the extensions in terms of states. The states are really where you need the money right now. That's where our major headwind is in terms of losing employment as state and local government. The cuts that are happening there are pretty draconian. That said, we're really limited into how much additional stimulus we can provide. I do think it is critical, though, we do extend tax cuts at this stage of the game. And let's just not even debate it all. I mean, I do think different tax cuts have different effects, but but at this stage of the game, just extend them. The cost of the economy is marginal compared to the deficit is marginal, and I'm a deficit hawk, is marginal compared to what could happen given the headwinds of the increases in taxes at the state and local level.
Diane, it's Dominic here again. The one thing we've consistently heard is that there's a debate, all right? It's not good, it's not bad. If that's the case there, are bonds the place to be for investors right now, or are we going to experience that kind of growth that's going to scare away bond investors?
You know, I actually think I'm still long on equities, although the bond market's certainly not been a bad place to be, and with the disinflation environment we have, it's not going to be horrible for some time yet. But I'm still bullish on, because I think the restructuring of the U.S. economy is one where we're moving towards a more investment, export-driven economy, which ultimately means an increase in profit share and an increase in equities.
All right, we're going to have to leave it on that note.
It's better for Wall Street than Main Street.
All right, going to leave it on that note. Hey, Diane, thank you so much. We appreciate you helping us get through this Fed decision and make sense of it. We appreciate it. Diane Swonk, Chief Economist for Mesirow Financial, and from our markets desk.